And we have come to our last profitability ratio that we are doing today. We are looking at return on equity. All right, so for return on equity, the word return means how much do you get back, right? Return means get back, right? How much do you get back for your investment? So this ratio, a lot of investors are very concerned about, and they will definitely calculate it. It means that for every $1 of money, $1 that an investor invests in this company, how much profit is your $1 going to earn? Okay, so what we do is that we take profit for the period, the amount of profit that your business has earned, divided by your average equity. So how do you know what your average equity is? Your average equity is your beginning equity plus your ending equity divided by 2, which means actually your 2017 equity plus your 2018 equity divided by 2. All right, so the beginning and the end. All right, and this return on equity, what it measures is that like I mentioned, it measures the profit that is earned for every dollar which your owner has invested in it. So it tells you how profitable your investment is. If your investment is not profitable, the percentage will be really low. If your investment is very profitable, you will expect the percentage to be very high. All right. Because why are business owners interested in return on equity? Because if your return on equity is very low in this company, you might as well take your money out and put it in another business or put it into the bank. Maybe the return on equity will be higher. So generally, businesses want to know this because the higher the return on equity means that the profit actually is higher. The profit earned by the business is higher, and it means that the business is more profitable. All right, because owners, they are one-minded. They want to have the best returns for that investment. If the investment is not a good investment, you should take the money out and put it away somewhere else. So business owners use the return on equity to do these things. They need to use it to decide whether they are going to continue to invest in the business, or do they want to take the money out and invest in other business, or even just to keep the money inside the bank and earn some deposits and earn some interest, earn interest. Okay, so this is your return on equity and why business owners are interested to know your return on equity. And so what you can do now is you can go on and take a look at the consolidated statement of comprehensive income. But you have to realize you cannot just use the numbers from here. Sure, you can use the profit for the year number, but if you look at the formula, there's this average equity, right? And where do you get the average equity? You will get it from your balance sheet. All right? And you will look at your beginning equity, like I mentioned to you, will be the 2017 equity, and the ending equity will be the 2018 equity. So will you be able to go on and try to use the financials of BreadTalk to calculate the return on equity? Now, when you are looking at equity, all right, so you would also want to don't look at the company equity, because BreadTalk is a group. You look at the group 2017 equity and 2018 equity. Key your answer into SLS. And with this, you actually have completed learning how to calculate the profitability ratios of a business. Next week, when I see you in class, I will teach you how to interpret, describe, and compare them. All right, so all the best. Please finish up your BreadTalk worksheet and have a happy Chinese New Year. Goodbye, students.